In the previous video, we talked about GDP and how it reflects a country's economic health. But GDP isn't just a number. It can have significant effects on various markets, including stocks, currencies, bonds, and commodities. In this video, we'll explore exactly how these changes happen. Let's get started. Stock markets. When GDP grows, it means businesses are thriving, consumer demand is high, and corporate profits are rising. What does that lead to? Higher stock prices. That's why investors tend to feel confident about the stock market when GDP figures are strong. But if GDP shrinks, the story changes, and stock markets often take a hit. Bond markets. The relationship between GDP and bonds is a bit more complex because it depends on the state of the economy. During periods of economic growth, market risks decrease, and people tend to move away from safe haven bonds. At first, bond yields might stay low, but as the economy approaches its peak, central banks may raise interest rates, causing yields to rise. In a recession, when GDP growth slows, demand for safe bonds increases, interest rates drop, and bond yields decline. As the economy starts to recover and GDP picks up, bond yields may initially remain low, but gradually rise as recovery gains momentum. Currencies, a growing GDP indicates a strong economy, which often leads central banks to raise interest rates. This attracts foreign investment and strengthens the country's currency. Conversely, when GDP falls, the currency typically weakens as investors pull back. Commodities. When GDP grows, demand for commodities like oil, metals, and agricultural products increases, pushing prices up. On the flip side, if GDP growth slows, demand drops and commodity prices usually fall. However, luxury items and precious metals like gold and silver often behave differently. They're considered safe haven assets and tend to perform well in uncertain economic conditions. Now that you know this, what do you think? How much does GDP affect our everyday lives? That's how GDP impacts markets. But there's another key indicator to consider: the Consumer Price Index, CPI, which measures inflation. In the next video, we'll dive into CPI and how it affects the economy and our daily lives. Stay tuned for part 3.